We have more tools in our toolbox. You may not know the tax efficient ways to get out of your real estate. There's so many ways it could be done. The question is, which one's right for you? Welcome to How to Retire on Time, a show that answers your retirement questions. Say goodbye to that oversimplified advice you've heard hundreds of times. This show is all about getting down to the nitty gritty. As always, you can text your questions to 913-363-1234. And remember, this is just a show, not financial advice. David, what do we got today?
Hey, Mike, how do you map out which rental homes to sell and which to push out?
Yes, this is actually an easier question than it may seem. So I believe the premise of the question is to avoid taxes. And if you have, let's say, 5 properties and you sell one of them, let's say for a $500,000 gain because you bought it at dirt cheap and all real estate appreciated in value, you don't want to pay $500,000 in long-term capital gains. Don't forget the depreciation recapture and all of this that you're paying in arm and a leg in taxes. And so a lot of people will say, well, shoot, it's going to take me 5 years to get out of all my properties. Kind of. So if you want to sell the property, pay the taxes, and then do whatever you want with it, and these are non-qualified assets at this point, remember the non-qualified asset conversation we had, then you might want to spread it out 1 or 2 a year and keep it within a certain taxable threshold. And we're looking within depreciation recapture and long-term capital gains. We're not looking as much on the income tax side of it. Okay. That may be true. And that's just a conversation of, okay, what properties have the lowest net operating income? So after all expenses are paid for, after you've paid property taxes, after you've done your depreciation recapture, all those things, how much cash flow are you actually taking? And then how much of the cash flow is income and how much gets reinvested? Many times we'll look at properties and we'll say, you're actually losing money on this property. So you'd want to prioritize those first and then other ones later, just from a cash flow standpoint. No one likes to pay monies for someone else to live in that house. That doesn't make any sense. But once you understand that, then you can line things out. If you want to pay the taxes, if you want to get out of it slowly over time, and maybe that's right for you. However, if you want to just be done with it, then you've got another option. One is a 721 UPREIT. So that's where you're going to take your property for fair market value, assuming you can get fair market value and negotiate that it's then rolled up into a REIT, a real estate investment trust, to where then you're getting basically a paycheck because your property is now as a part of that overall umbrella. And as a part of that trust, you're going to get OP units. Those are operating partnership units. And you're just going to receive basically income as a partner.
Do you still own the property, but it's just part of this trust now, or do you sell it?
Nope, you don't sell it.
Oh.
You just move it in there and you receive OP units in exchange for it.
Okay.
So if you've got like a $5-10 million apartment complex, that might be very appealing to you. But it's all going to go into one property. So that might be concerning to you or one REIT.
Okay.
And how is the REIT managed? What's the dividend? Are they leveraged? Are they not leveraged? Leverage for the uninitiated, that they're taking, real estate investors know this, but for everyone else, you're taking basically debt to try and get better cash flow. So you really want to get a CPA or someone that can do a deep dive into the financials of the REIT, that it would be inherited so that you're not moving your property into something that's just risky. Think of it this way. If you're a healthy person, do you want to move into a room with a bunch of sick people? You'll probably become sick like everyone else. If you take a healthy property and you move it into a REIT with a bunch of unhealthy properties because they're not being well managed, maybe the cash flow is hurting, maybe there's a lot of neglect, it's going to take a toll at some point on your property. So you want to make sure that things are very suitable, okay? Or you could do a 1031 exchange into a Delaware statutory trust and buy a couple of different DSTs. Instead of taking a 721 UPREIT, which is fractional ownership of a trust, you're buying fractional ownership of the actual real estate property.
Okay.
So that's another way to do it. And you could buy a couple of them. Think of like student housing, self-storage units, boring properties, but someone else is the landlord. You're still making you're getting cash flow. So you're getting your income, and the appreciation of the property will continue, assuming that it does appreciate. And then in maybe 5 to 7 years, you'll sell it and defer it into another 1031 exchange into the next property. And you just maintain your cash flow over and over until you pass. And then your beneficiaries get the step up in basis. That means that they get it tax free at that point.
On that second option though, the DST, that you are selling your real property, right? In that case,
You sell it, but you move the proceeds to a qualified intermediary.
Okay.
You cannot touch the assets.
Yeah.
And there's a whole thing, 45 days to identify your properties, 180 days to actually get it there.
Okay.
So there's some nuance there. You could take some of the cash out and just pay the taxes on that portion of it.
No.
So it is complicated in how it's done, but if you want to just be done with it, then the question is, can you get a good deal on the sale of your property? Because there's no limit to this, at least right now, based on current law. It's been floated to limit this. Right now, there's no limit that I'm aware of. But you could just sell all your properties and be done with it, and now you've got your cash flow.
Okay. And so when you say limited, like there's no limit on the dollar amount of selling all these properties. It could be tens of millions or 100,000.
Yep.
Doesn't matter. Okay.
There's been talk of making a 5 million or so limit on 1031 exchanges. Everything above that would have to be taxed.
I see.
That's just never actually been passed.
Okay.
So a lot of options there. Many people either don't know about the 721 UPREIT or the 1031 exchange, the Delaware Statutory Trust. And if they did know about it, there are many restrictions. So their firm will just say, we don't do that, so you can't facilitate that. And then people are compromised saying, well, you just have to sell it, pay the taxes, and that's kind of it. We have more tools in our toolbox than are common for those that do want to explore other tools. That's why we're here.
Yeah, we at Kedrick, I mean, you're saying have a lot of tools available, yeah.
That's why you just go to retireontime.com and click the button that says Discover What's Possible. We wrote it that way because you may not know the tax-efficient ways to get out of your real estate, like what we just talked about. And there's other ones we haven't even talked about. I mean, we could even explore things like qualified opportunity zones or oil and gas partnerships that can wash out certain taxes in certain ways. There's so many ways it could be done. The question is, which one's right for you?